Hello and welcome to Yahoo Finance's special breaking news coverage of the October Fed decision. I'm Josh Lipton, here with my colleague Julie Hyman, and we're just moments away now from the Fed decision and markets. You can see we are higher. Just a quick check of the popular averages here. You have the Dow up 120 points. The S&P 500, your broad gauge, is about 0.2%. The tech-heavy NASDAQ, it's about 0.6%. So Julie, the big day's here. You've marked your calendar. What do we expect? We expect a cut by 1/4 point. We know some of our central bankers concerned about the labor market. They say cooling, maybe some downside risk, maybe also announcing an end to shrinking the balance sheet.
Yes, maybe. Some economists have called for that. They're concerned about all this stuff, but they don't necessarily have the information that they need to make a decision beyond today. We've heard some economists say they're flying blind. They don't have those reports from the government because of the government shutdown. So they might be concerned about the labor report, but they have the labor force, but they have to rely on private surveys right now. And so there are some economists, market strategists who have said that's not enough to make another decision. Even Christopher Waller, who's a member of the Fed, has talked about not necessarily having enough information to cut after today this year. So we'll see if we get any hints about all of this.
Yeah, very good point. So government shutdown started October 1st. To your point, they have inflation data, they have CPI data. They don't have that big jobs report.
Well, yes, and they're not going to get another CPI report as long as it's shut.
Yeah. So as I think about cuts ahead, that's one issue. The second issue is, how do you think about cuts ahead when your inflation target is still 3% per student? Steve Sosek yesterday was saying, should we think about 2%? Is that a suggestion? Is that how we should think about it going ahead?
I mean, maybe, or maybe they should change it, although, it doesn't seem like they're going to. But yes, it doesn't seem like a realistic target.
So lots of cross currents, lots of tailwinds for our central bankers right now. We'll hear shortly what they have to say. Let's get to Jennifer Schonberger with the decision.
25 basis point rate cut. The Federal Reserve lowering its benchmark interest rate by 1/4 percentage point to a new range of 3.75% to 4%. The second rate cut this year. Now, this was a split decision. Fed Governor Stephen Miron dissented, preferring to cut rates by a jumbo 50 basis point rate cut. On the flip side, Kansas City Fed President Jeff Schmidt wanted to hold rates steady instead of cutting rates. Fed officials announced they will stop shrinking their balance sheet by December 1st. Now, when it comes to the state of the economy, Fed officials said that economic growth is expanding at a moderate pace. That after noting last month that growth had moderated. Now, when it comes to the state of the job market, officials said they haven't seen much change in the state of the job market since they have gotten official data, which they stopped getting as of the month of August because of the government shutdown. They said, quote, job gains have slowed this year and the unemployment rate has edged up but remained low through August. More recent indicators are consistent with these developments. They also reiterated that downside risks to employment rose in recent months, and officials reiterated in their policy statement that in considering additional adjustments to the target range of the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. Guys?
Jennifer, now we turn to the presser. Jay Powell's going to step up to that mic. You're going to be in the room, Jen. What are you going to be listening for?
Hey there, Josh. So a couple of interesting points to digest here. I think one, I was a little surprised to see Kansas City Fed President Jeff Schmidt dissent. I thought that maybe he wouldn't want to rock the boat there, but he had indicated coming into this meeting that he had concerns about inflation and that if the committee were to cut rates again, perhaps that could ignite demand and give firms additional pricing power, offering them the opportunity to pass on higher costs from tariffs to consumers, leading to higher prices. So that was a bit of a surprise. I did expect Miron he pre-announced that he wanted to cut by 50 basis points, so no big surprise there. As for what I want to hear from Powell, I want to see how he frames policy action for December. I don't think that he's going to be committal. I think he's going to say we need to be data dependent. We need to continue to take things meeting by meeting. Of course, they're still waiting to get official data as they wait the government to reopen. However, what I will be looking for in terms of clues for December is how he characterizes the state of the job market. They indicated in the policy statement that things haven't really changed in terms of the state of the job market. I'd like to get some more color there because they also said in the statement that downside risks had deteriorated. So looking at the anecdotal evidence and some of the unofficial private data numbers like ADP, are they more concerned now about the job market? And if they are, then that to me would point to another rate cut on the table for December.
All right, Jen, thank you. Let's get to Yahoo Finance's Ali Canal right now with the latest market action after the Fed's interest rate decision. Ali.
Yeah, we're seeing the major indexes tick slightly higher there. So the 2 p.m. Fed decision, you're seeing the Dow rise slightly. Same with the NASDAQ. We are now up around 0.6%. S&P 500 up 0.2%. Now, the equal weighted index is underperforming the benchmark S&P in part due to the surge that we've seen across some of those big tech players, NVIDIA hitting that $5 trillion market cap for the very first time. I also want to take a look at what we're seeing in the bond market, some of the reaction there. We are seeing yields tick up slightly from that decision. We're up around 3 basis points on the 10-year, trading now above 4%. Throughout the day today, we were firmly below 4% as there was increased buying due to the expectation that the Fed will continue its easing cycle. The 30-year yields, we're seeing a similar story at 3 basis points, just around 4.6%. And the dollar edging slightly higher there, hovering at that 98 level, still significantly below the 100 psychological level. And as we know, year to date, the dollar has just been underperforming. We are down around 10% here, Josh.
All right, thank you, Ali. Well, for a closer look now at the Fed and its rate-cutting path, let's welcome in here JP Morgan Asset Management Global Market Strategist, that would be Mira Pandit, along with Schwab Center for Financial Research Fixed Income Strategist Colin Martin. Welcome to you both. Mira, I will start with you. So you get the cut. They're going to stop shrinking the balance sheet on December 1st. Myron dissents. He wanted that jumbo size cut, 0.5 point. Schmidt dissents in favor of no rate change. Your immediate thoughts, Mira. What do you make of those headlines?
When you're flying blind, you have to stay the course and stay in autopilot. So I think at this meeting, they didn't have a whole lot of choice, especially given what they had signaled in the last meeting in their summary of economic projections and in their dot plot as to where they were going. 2 rate cuts further for this year. We're getting one now. But again, there's a lot of question about what happens in the final meeting of the year. And certainly this additional dissent was a bit of a surprise. If you had said there were 2 dissents this meeting, I would have assumed it was Myron and perhaps one other, perhaps favoring a larger cut, as there was some idea that we could have seen that last time around. But instead, it's very much underscoring the fact that we have 2 camps here. A camp that is a little bit more concerned about hotter inflation and a camp that is more concerned about weaker job growth. And they essentially appear to be split right down the middle if you looked at the dots from last month. So clearly that debate rages on within the Fed, and that debate is less equipped with the tools and the data they need to think about decision making. Didn't stop them from the pause or the end to QT, which was clearly the other thing that stood out here. And then the last thing that stood out to me is they seem to want to emphasize the fact that the economy is still growing. They've added in the statement that first line there that the economic activity is still expanding, but at a moderate pace as opposed to moderating. So it does seem like they're trying to strike a little bit more of an optimistic tone on the activity that they are seeing in the economy.
So, Colin, given that optimism, cautious optimism, I guess we would call it, as we look towards the last meeting of the year, is it just off the table if the government is shut?
I wouldn't say it's off the table. And if you look at implied probabilities right now, I mean, that assumes we still don't have data and there's still a pretty high probability of a cut in December.
But do you think they have it right? I mean, does the market have it right?
We don't think they do. That's been our case for a while, and I think the dissent by Schmidt kind of plays into that. I think Mira made some fantastic points about the dispersion. As much as there's people that are, a little bit more dovish, there is a more hawkish contingent. And if you look at the dots, we didn't get dots this time around, but if we looked at the September dots, it's a really wide range of views. I think these first 2 cuts in 2025 were sort of the easy ones. I think it gets a little bit harder from here. One, because we don't have the data. But even if we did have the data, the trend was a modest slowdown and kind of loosening of the labor market, but not anything falling off the cliff. There's plenty of negative things that we can point to with the labor market, but a 4.3% unemployment rate is not that bad. If we zoom out and look at a 40 or 50 year take of the U3, most economic environments, we'd be happy with that. So I don't think that's something to be too worried about. Meanwhile, inflation is just too high, 3%. You were talking about, are they going to change their goal? Is it an unofficial 2%, 3% goal? It's still too high. And yes, Schmid won't be a voter next year, but Beth Hammack will be. And her dot from September suggested that she wouldn't have voted for the previous rate cut. She probably would have dissented here as well. So the path going forward is very uncertain, and I don't know what the implied probabilities look like for December just yet, but we're probably still a little bit below them. I think it remains to be seen what will happen in the next 6 weeks.
So Mira, Colin making a good point there. It's the path forward's uncertain. Let's say in December you didn't get that cut, Mira. I'm curious how you think the stock market would react. The market would appreciate a cut. Does it need a cut to keep moving higher?
As long as we continue to see positive earnings results from many of the AI-linked names and the AI-direct companies, and we continue to have some enthusiasm around that story, I don't think the market needs a cut and needs easing at this point to continue to move higher. We're also expecting that you come into next year and you start to see some tax refunds delivered to consumers. We looked back at last year, about 43% of the tax refunds that are issued come through in February. So you could have a pretty nice early start to the year where if you know you're getting a refund, you file your taxes very quickly, you get that boost because of some of the new tax provisions within the One Big Beautiful Bill, and that fuels a bit of spending. So you still have the fiscal story intact, you still have the AI story intact. You don't necessarily need that cut in order to keep that story going.
I wonder if you also need it from an economic perspective either, right? If, because what you're describing isn't just the market environment, it also implies something about the economic environment, that the cut is not needed to sort of keep that party going.
Yeah, absolutely. I mean, we think the economy is doing pretty well. The Fed statement suggested that. GDP looks pretty strong right now. And if there are issues out there, let's say there are some things that could cause a slowdown here and there or a risk asset hiccup, I don't think it's an interest rate problem. I don't think interest rates are holding anybody back right now. So that's part of the reasons why we don't think that they need to be super aggressive in their rate cuts going forward. They can take some time. But I'll piggyback on Mira's points. I mean, things are looking pretty good right now. They don't need to be cutting. If we look at risk assets on the bond side, whether it's high yield markets, leverage loans, there's a lot of concerns out there given some high profile defaults, maybe some bad loans at regional banks. But for the most part, fundamentals are okay. Interest coverage ratio is okay. Leverage is down relative to the peaks over the past few years. So there's some risks out there, but I don't think interest rates are one of them for most companies.
Mm-hmm. Mira, Colin brings up a good point. I mean, listen, if you looked around, Mira, and you said, listen, GDP is hanging in there. I think the Atlanta Fed tracker, we're up near 4, right? You said unemployment was still low. Stock market is rocking. Credit spreads are tight. That's not typically the backdrop you would cut into.
No, and just to further that point in terms of whether the economy actually needs cuts, the NFIB does their small business survey. The biggest problem that companies are citing, and on the small business side where interest coverage and the debt burden tends to be more of a burden than it would for a larger company, they're still citing quality of labor as their biggest issue, tied with taxes, which I think is a little bit implicitly a nod to tariffs. But interest rates is much further down the list, kind of in the back half in terms of what some of their biggest challenges are. So it doesn't seem like companies are finding the interest rate environment too onerous. However, the quality of labor is an interesting problem because it also seems to point to the fact that it's not actually the cost of labor and the fact that companies are just on the cusp of needing to lay people off. It's that they just don't want to hire people unless they're going to generate revenue. And I think that plays into lower or higher youth unemployment relative to some of the stories we're hearing about some of the higher paid workers getting hired in different industries, maybe not specifically tech, except for at the very top end of the range there. But I think companies are looking for people to drive revenue in this environment. They're not so worried about interest rates. They're not so worried about cost of labor. It's really about what's going to move the needle forward.
I mean, if that's true, then does that also, I mean, we've had layoffs recently, some high profile layoffs. UPS is laying off people, Amazon's laying off people, Target's laying off people. But to your point, that's not an interest rate problem, perhaps.
Yeah, I don't think that's what's driving it. Yeah. And I mean, layoffs are concerning. And even though I just gave a pretty positive outlook, we have concerns here and there. So we're not suggesting things are going to continue to go gangbusters. We're not saying go take too much risk out there. But things look pretty good right now. On the layoff front, we've had some of these head fakes before. At the end of 2022 and 2023, a lot of high-profile companies suggesting hiring slowdowns or layoffs, and we didn't see it in the data. So I think we need to see, with the government shutdown, maybe it takes some time to see the data, but we want to see how that trickles into the official statistics as opposed to just headlines for now.
All right, Colin Meara, that was a great way to start. Appreciate it. Thank you. And you'll be back with us shortly after that news conference. Much more coverage of the Federal Reserve's latest rate cut. That is straight ahead. The Fed cutting interest rates by 25 basis points just moments ago, and for more reaction now, let's get to Luke Tilley, chief economist at M&T Bank and Wilmington Trust and former Philadelphia Fed economic advisor. Luke, it is great to see you. So you got the decision, Luke. What do you make of it? Would it have been your decision?
Yeah, I think I would have done the same thing if I was in that seat. Look, the Fed here is really concerned about the labor market, and I think rightfully so. A couple of your previous guests were talking about how the economic data looks okay. But if you dig into the labor market data, you see a lot of weakness. So if you just take private jobs, and separate the healthcare sector, because the healthcare sector is always going to add jobs. It added jobs through the global financial crisis when it felt like the sky was falling. So take out the healthcare jobs. All the other sectors cut 92,000 jobs over the past 4 months since the tariffs were put into place, according to BLS data. And they don't give you information by firm size, but if you look at the ADP data shows about 110,000 jobs cut by small firms that employ 1 to 49 employees. That's the same kind of thing that the Fed is hearing from businesses that are talking to them in the regional banks. And what they are really concerned about is that you've got a lot of weakness there in the labor market, jobs being cut by those smaller firms, and that's why they're trying to get ahead of it. So I'm not surprised at all that they cut by 25 basis points, and I think that they'll keep cutting.
So you think they'll keep cutting, Luke? It's Julie here. You think they'll keep cutting even in the absence of, government data between now and the end of the year?
I think it'll be challenging the less and less data that they have, but at least on the labor market side, you've got the ADP data, which will continue to be published. You've got the new Revelio data. If you look at those two together, neither one of them are suggesting a real big reacceleration in employment. So with the information that they have, then I think that the risks are to the downside. Of course, it's very challenging the more and more that you're flying blind. But the data that we have up until now is that they should be cutting rates.
So they cut, Luke, even as inflation is above target. Is 3% the new 2%, Luke?
I don't think so. A CPI is running at 3%, but as the common narrative, and I think it's true that a lot of that has to do with the tariffs and a one-time push-up on goods. The couple of important things there is that the services side inflation continues to decelerate and come down. It's coming down with a very weak housing market that's weighing on the shelter component. We expect that to continue. And the other thing is that the CPI runs about 40 to 50 basis points higher than the PCE. So, CPI at 3%, that puts the PCE at 2.5%. That's really not that high. The Fed's never going to say that we're okay with 2.5 to 3% inflation, but I also don't think that they're going to club the economy over the head and try and drive it further down. Just for a couple of 50 basis points on inflation. I really don't think that it's much of a problem, and they're much more worried about that faltering labor market, because if you start to get negative labor market numbers, there's no way that inflation is going to remain high. You're just going to have people cutting back on spending, and you'll get weaker inflation coming from that.
Luke, one of my colleagues just shared that it was September 2019 the last time we saw dissents on both sides. And in this case, Schmid saying he didn't want any cut, and of course Myron saying he wanted a larger cut. What does that indicate, if anything, about the decision-making process inside the Fed and what we might get next month, or in December, rather?
Yeah, it's a great question, Julie. And I think that what it reflects is a lot of uncertainty. You've got a couple things going on. One, the lack of data makes it very hard to gauge what they should be doing. Second, you've got a unique environment here where you've had the onset of tariffs and also the somewhat conflicting data with strong GDP and the weak labor market. So that's going to cause a little bit more difference of opinion. And then you just have the individuals involved, right? Steve Myron, we know that he wants to be cutting rates. He said that well before he got in there. And I'm not surprised at all to see a Kansas City Fed president erring to the hawkish side. They've been doing that for a couple of presidents now, from Tom Honig to Esther George. Must be something in the water in Kansas City, and they sort of err on the hawkish side. But I don't think it's really an issue. I think it's good that they're having a spirited debate.
You know, Luke, you mentioned tariffs there. I'm just curious to get your thoughts, Luke, because we haven't seen the worst case scenarios play out, but I'm curious what you see ahead.
Yeah, Josh, I'm not going to try and predict where the tariffs are going to go in terms of the levels and the trade deals and whatnot. But what I think is underappreciated is just how challenging that change to business costs is. I was talking, just a couple minutes ago about how the job losses that we're seeing in different sectors are predominantly coming from those smaller firms. And those smaller firms are the ones that have less levers to pull and less maneuverability around such a sharp change in labor costs. So I think that the impacts have been pretty significant. Clearly, we are collecting a lot of tariff revenue, and somebody's paying that, either the companies or the ultimate consumer. Our daily tariff collections up through yesterday are the highest that they've been through that day of the month since the implementation of tariffs. So we know that those dollars are being paid, and it's a fairly significant tax increase and causing challenges for a lot of these firms. I don't think that it's really playing through to inflation all that much, because the consumers are not really in a place to shoulder those kind of price increases. They're just sort of taking it away on the services side and spending less there, Josh.
All right, Luke, as always, good to see you. Thank you.
Thank you.
Going forward, solid data, or potentially the lack thereof, will play a crucial role in additional Fed decisions. And how much patience does the Fed have from here? Well, joining us now, we have former St. Louis Fed President Jim Bullard, who currently serves as the Dean of the Mitch Daniels School of Business at Purdue University. Jim, great to see you, as always. So we're waiting now, Jim, for Jay Powell, of course, to step up to the mic, answer those reporter questions. But we have the decision, Jim. Curious, high level, what you make of it, what you made of the cut. And do you think, Jim, another cut is coming in December? What are the variables that depends on?
This one was widely anticipated, so it came through as expected. They ended the balance sheet runoff, which was also widely anticipated in financial markets. They won't actually end, it doesn't sound like, till December, but they certainly set it in train. So I think this is widely anticipated. Now, for December, I think it's a little more open decision. I think the chair will emphasize that they'll need to see data that support going ahead in December before they'll commit to that. And then for 2026, the committee has not said very much about 2026, and this is the first time that January will really come into play here. And I don't think that they intend to go to make a move in January. I think that they would want to spread any future moves out at a slower pace. So we'll see. Might be a little too early to get into that, but we'll see if that comes out in the press conference here.
Jim, we've been talking all day and for the previous days about the lack of data coming out from the government. As somebody who served on the FOMC, talk to us a little bit about what you might think is going on inside the room as they're trying to make this decision without that data. Yes, there are private reports. Yes, CPI came out, but they don't have the official jobs data. So how do you think that process is now working?
They love the non-farm payrolls report inside the Beltway, and that's the favorite piece of data for the committee. So they are missing that. I would say you can look at something like the Kansas City Fed's Labor Market Conditions Index, and you can look at it with or without the non-farm payrolls numbers. And they've done that, actually. So if you click on that, you will find that the labor market looks like it's about an equilibrium. And that's consistent with a relatively low unemployment rate. So I think the main issue for the committee here is that the economy seems to be reaccelerating. And except for the payrolls number, which we don't have, labor market seems okay, and you still got pretty high inflation. So I think that's going to cause the committee to bring rate cuts to a halt at the end of the year here.
You know, Jim, in the absence of government data, though, you do see this this clockwork of headlines here of companies laying off folks, Jim. I mean, GM, Amazon, Target, Molson Coors, Applied Materials. I know it's anecdotal to some extent, Jim, but I'm curious, you see those headlines. What do you make of that? And what do you think the Fed makes of it?
Yeah, I think there's AI feeding frenzy for the large caps, the so-called, the major cloud providers for AI, and they want to show that they're not behind, and they want to argue that they're using AI to eliminate jobs. That's helping them with their stock price, but not at all clear to me that that's really what's going on. I think they're probably reallocating toward AI so as not to fall behind in the race with the other mega cap companies. Other companies have, I think, different issues in different places. Certainly, General Motors, completely different type of business. Retail, also non-Amazon retail, completely different sort of business.
Jim, I want to come back to the dynamics on the Federal Open Market Committee, because as we've been talking about, we had one dissent in the form of Schmid, who said he didn't want to cut at all, and then Stephen Myron saying he wanted to cut by a half of a percentage point. What does this tell us about the dynamics within the committee, especially given that Jay Powell is coming to the end of his tenure?
Yeah, I'm sure the chair probably doesn't mind getting a dissent on both sides. That kind of averages out, and so that has happened sometimes in the past. I do think there's a contingent on the committee that is concerned that inflation is still running at 3% and that it has not come down very much in the last 18 months, really, and they want to see more progress on that. There is a good story for that the tariff effects are temporary and that the inflation will continue to move down next year. But I'm sure they'd like to see some evidence of that before committing to further rate cuts. So I think the way to think about these cuts this fall is that this is a recalibration of the setting of monetary policy, and an appropriate one, but one that still leaves the setting a little bit restrictive so that you can still get downward pressure on inflation and eventually get back to 2%.
Jim, I got to ask you, Powell's term, as we know, coming to an end in May. So now the question becomes, okay, who is the next, Jim, most powerful central banker on the planet? Bessent, our Treasury Secretary, he says five names, Jim, in no particular order. Got Hassett, Waller, Warsh, got Rick Reeder, Michelle Bowman. I'm interested, Jim, how you think the Trump administration is screening for this. What qualities do you think they're looking for?
I thought the Treasury Secretary put together a pretty good process. I was part of that earlier. And I think these are all very respectable candidates. I know at least 4 out of the 5 very well. Rick Reed, I don't know as well. But so I think you've got a talented group. Like any big job, they would bring different qualities to the table. And they would probably have to, adjust to the position in different ways. And so I think that's a judgment that the Treasury Secretary and his team will have to make, and ultimately the president will have to make about who they want in this spot.
Do you think, Jim, that there's still a risk of the person being seen as a proxy for the administration? And if that's the case, is there then sort of an issue with how those decisions will be viewed by the market?
Yeah, I mean, if the market starts to worry that interest rates will be kept unnaturally low and that'll feed into inflation, they'll price that right in right away. And so you would get an inflation risk premium. So I think you need to, for anybody that would take the job, you need to commit to the 2% inflation target and make sure that you're going to take steps to maintain that level of inflation. Otherwise, markets will just price it in before you even get in the job.
Jim, I always like your take on this. We're waiting for the presser. We're waiting for Powell to step up there. Reporters are gonna ask a lot of questions, Jim. Let's say I make you a reporter, Jim. You're now a business journalist. You have the chance to ask Powell a question or two. What would be top of mind for you?
I think the questions here might be about the balance sheet. They're stopping the runoff. The Treasury Secretary seems to have said that the large balance sheet is maybe not something that he wants. So are there plans for the committee to get the balance sheet down to a smaller size? I think there are ways to do that, but the current committee seems to not be oriented in that direction. That seems to be different from what the Treasury Secretary is looking for.
All right, Jim, thank you as always. Appreciate your time, sir.
Sure.
Fed Chair Jerome Powell taking the podium. Let's listen in.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although some important federal government data have been delayed due to the shutdown, the public and private sector data that have remained available suggests that the outlook for employment and inflation has not changed much since our meeting in September. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals and in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by a 1/4 percentage point. We also decided to conclude the reduction of our aggregate securities holdings as of December 1. I will have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a moderate pace. GDP rose at a 1.6% pace in the first half of the year, down from 2.4% last year. Data available prior to the shutdown show that growth in economic activity may be on a somewhat firmer trajectory than expected, primarily reflecting stronger consumer spending. Business investment in equipment and intangibles has continued to expand, while activity in the housing sector remains weak. The shutdown of the federal government will weigh on economic activity while it persists, but these effects should reverse after the shutdown ends. In the labor market, the unemployment rate remained relatively low through August. Job gains have slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Although official employment data for September are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index suggest that total PCE prices rose 2.8% over the 12 months ending in September, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8% as well. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or two or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a 1/4 percentage point to 3.75% to 4%. Higher tariffs are pushing up prices in some categories of goods, resulting in higher overall inflation. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside. A challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. With downside risks to employment having increased in recent months, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. We continue to face two-sided risks. In the committee's discussions at this meeting, there were strongly differing views about how to proceed in December. A further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it. Policy is not on a preset course. At today's meeting, the committee also decided to conclude the reduction of our aggregate securities holdings as of December 1. Our long-stated plan has been to stop balance sheet runoff when reserves are somewhat above the level we judge consistent with ample reserve conditions. Signs have clearly emerged that we have reached that standard. In money markets, repo rates have moved up relative to our administered rates, and we have seen more notable pressures on selected dates, along with more use of our standing repo facility. In addition, the effective federal funds rate has begun to move up relative to the rate of interest on reserve balances. These developments are what we expected to see as the size of our balance sheet declined and warrant today's decision to cease runoff. Over the 3.5 years that we've been shrinking our balance sheet, our securities holdings have declined by $2.2 trillion. As a share of nominal GDP, our balance sheet has fallen from 35% to about 21%. In December, we'll enter the next phase of our normalization plans by holding the size of our balance sheet steady for a time, while reserve balances continue to move gradually lower as other non-reserve liabilities, such as currency, keep growing. We will continue to allow agency securities to run off our balance sheet and will reinvest the proceeds from those securities in Treasury bills, furthering progress toward a portfolio consisting primarily of Treasury securities. This reinvestment strategy will also help move the weighted average maturity of our portfolio closer to that of the outstanding stock of Treasury securities, thus furthering the normalization of the composition of our balance sheet. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting our maximum employment, bringing our inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, are you uncomfortable with how market pricing has assumed a rate cut is a foregone conclusion at your next meeting?
Well, as I just mentioned, a further reduction in the policy rate at the December meeting is not a foregone conclusion, as I've just said. So I would say that needs to be taken on board. We had, I would just say this, 19 participants on the committee. Everyone works very hard at this and takes their obligations to serve the American people very seriously. And at a time when we have tension between our two goals, we have strong views across the committee. And as I mentioned, there were strongly differing views today. And the takeaway from that is that we haven't made a decision about December. And we're going to be looking at the data that we have, how that affects the outlook and the balance of risks. And I'll just say that.
You and some of your colleagues have framed last month and maybe today, I won't put words in your mouth, there's a risk management exercise. At what point do you conclude that you've taken out enough insurance? Are you looking for some kind of improvement in the outlook, or could this unfold along the lines of last year where you made a sequence of adjustments and then waited to gather more information?
So the way we have been thinking, well, I've been thinking about it is the risks to the two goals. For a very long time, the risk was clearly of higher inflation. And then that has changed now. And as we saw particularly after the July meeting, we saw the downward revisions in job creation, we saw a very different picture of the labor market, and it suggested that there were higher downside risks to the labor market than we had thought. And that suggested that policy, which we had been holding at a I would say modestly, others people would say moderately restrictive level, needed to move more in the direction over time of neutral. If the two goals are sort of equally at risk, then you ought to be at neutral, because one of them's calling for you to hike and one of them's calling for you to cut. So if that got back into balance, then you'd want to be roughly at neutral. So in that sense, it was a risk management. And I would say the same about today, sort of the same logic. But as I mentioned, going forward is a different thing.
Claire.
I'm Claire Jones, Financial Times. Thank you for taking this question. We've just heard from you that the discussion in December and the conclusion of the discussion is not a foregone conclusion. I'd like to just dig into that a little bit more about what sort of arguments were brought up. Was there any consideration, for instance, of the investment we're seeing in AI and some of the generation of household wealth through rises in stock prices related to the AI boom? Thank you.
I wouldn't say that's a factor in everyone's assessment of the economy. I wouldn't say it's the driving factor. I don't think for anybody. I guess I would say it this way. Once again, I would just point out that we have the situation where the risks are to the upside for inflation and to the downside for employment. We have one tool. It can't do both of those. You can't address both of those at once. You've got a very different situation. So you have some people have different forecasts, right? So they'll forecast faster or slower progress on one or the other, and they also have different levels of risk aversion. And some will be more averse to inflation overruns, and some will be more averse to underruns of employment. And so you put that together, and as you can see from the SEP and from the public discussion that goes on between the meetings when more participants go out and talk, they're very disparate views, and they were reflected in strongly differing views in today's meeting, as I pointed out in my remarks. And that's what leads me to say that, that we haven't made a decision about December. I always say that it's a fact that we don't make decisions in advance. But I'm saying something in addition here, is that it's not to be seen as a foregone conclusion. In fact, far from it.
Can I just ask a quick follow-up on QT? How much of the fund impressions we've seen in money markets are related to the U.S. Treasury issuing more short-term debt?
That could be one of the factors, but the reality is we've seen, the things that we've seen, higher repo rates and federal funds rate moving up. These are the very things that we look for. We actually have a framework for looking at, what the place we're trying to reach. What we said for a long time now is that when we feel like we're a bit above what we consider a level that's ample, that we would freeze the size of the balance sheet. Of course, reserves will continue to decline from that point forward as non-reserve liabilities grow. So this happened, some things have been happening for some time now, showing a gradual tightening in money market conditions. Really in the last, call it 3 weeks or so, you've seen more significant tightening, and I think a clear assessment that we're at that place. The other thing is, the balance sheet is shrinking at a very, very slow pace now. We've reduced it by half twice, and so there's not a lot of benefit to be holding on to get the last few dollars, because again, the balance sheets, the reserves are going to continue to shrink as non-reserves grow. So, there was support on the committee as we thought about it to go ahead with this and announce, effective December 1, that we will be, freezing the size of the balance sheet. And the December 1 date gives the markets a little bit of time to adapt.
Colby.
Thank you. Colby Smith with the New York Times. So much of the rationale for cutting interest rates, even as inflation moves away from the 2% target, seems to be, that there are these mounting downside risks to the labor market. But if those don't materialize and the labor market either stabilizes around current employment levels or even starts to strengthen somewhat, how would that change your perception of how much interest rates need to fall from here? Would you then be a bit more concerned about underlying inflation and the possibility of second round effects from tariffs?
Yeah, I mean, in principle, if you were to see data that suggested that the labor market's strengthening or even that it's stabilizing, that would certainly play into our decisions going forward. So, we do have, we get some data. The labor market is a place where we get, for example, we get the state level data on initial claims, which are sending a sort of a signal of more of the same. We also get job openings. And we'll get lots of survey data. We'll get the Beige Book and things like that. So we'll have a picture of what's going on in the labor market, and the fact that we're not seeing an uptick in claims or a downtick really in openings suggests that you're seeing maybe continued very gradual cooling, but nothing more than that. So that does give you some comfort.
But if this shutdown lasts a while longer and you don't have that data in hand, I'm just wondering how that hinders the committee's ability to assess the state of the labor market and make the right policy decisions, and also how much is that factoring into the debate about December?
Yeah. So we get like I mentioned what we get in the labor area. We get some data in inflation, some data in economic activity. And we'll have a picture of what's going on. We also will have the Beige Book again. I would say we're not going to be able to have the detailed feel of things. But I think if there were a significant or a material change in the economy one way or another, I think we'd pick that up through this. So in terms of how it might affect December, it's really hard to say. December's the meeting's I guess 6 weeks away. We just don't know what we're going to get. If there is a very high level of uncertainty, then that could be an argument in favor of caution about moving, but we'll have to see how it unfolds.
Steve
Leisman, CNBC. Mr. Chairman, can you characterize the meeting in terms of, you said strongly differing views. Was this a close call, this cut, or was it a close call maybe the other way because you had dissents on both sides? Thanks.
So I was referring to the discussion about, to the extent it related to December. You saw we had two dissents, one for 50 and one for no cut. So, that was a strong, solid vote in favor of this cut. The strongly differing views were really about the future. What does that look like? And I think people are saying, they're noticing stronger economic activity. Forecasters generally, broadly, have raised their economic growth forecasts for this year and next year, in some cases quite materially. In the meantime, we see, a labor market that's kind of, I don't want to say stable, but it's not clearly in motion. It's not clearly declining quickly in any case. It may be just continuing to gradually cool. And again, people have different forecasts and expectations about the economy and different risk tolerances, and so there's you read the SEP, you read the speeches, there are differing views on the committee, and to the point where I said what I said.
And just to follow up on the balance sheet, if you stop it, the runoff now, does that mean you have to go back to actually adding assets sometime next year so that the balance sheet doesn't shrink as a percent of GDP and become a tightening factor?
So you're right. The place we'll be on December 1 is that the size of the balance sheet is frozen. And as mortgage-backed securities mature, we'll reinvest those in Treasury bills, which will foster both a more Treasury balance sheet and also a shorter duration. So that's what. In the meantime, if you freeze the size of the balance sheet, the non-reserve liabilities, currency, for example, they're going to continue to grow organically. And because the size of the balance sheet is frozen, you have further shrinkage in reserves. And reserves is the thing that we're managing that has to be ample. So that'll happen for a time, but not a tremendously long time. We don't know exactly how long. But at a certain point, you'll want to start reserves to start gradually growing to keep up with the size of the banking system and the size of the economy. So we'll be adding reserves at a certain point, and that's the last point. Even then, we didn't make decisions about this today, but we did talk today about the composition of the balance sheet, and there's a desire that the balance sheet be right now it's got a lot more duration than the outstanding universe of Treasury securities, and we want to move to a place where we're closer to that duration. That'll take some time. We haven't made a decision about the ultimate endpoint, but we all agree that we want to move more in the direction of a balance sheet that more closely reflects the outstanding Treasuries, and that means a shorter duration balance sheet. Now, this is something that's going to take a long time and move very, very gradually. I don't think you'll notice it in market conditions, but that's the direction of things.
Janelle.
Janelle Marte with Bloomberg. How are officials interpreting the latest CPI report? So some components came in lower than expected, but core inflation was still at 3%. So at this moment, what are you learning about the drivers? And also, do you view that the risks are greater that the Fed makes a mistake on employment or inflation?
So the September CPI report, we didn't get PPI after that, which is important for translation into what we look at, which is PCE inflation. But we can still make a pretty good assessment of what that will be. When we get PPI, there might be some adjustments. But so directionally, it was a little softer than expected, and we always break it down into the three components. So basically, you've seen goods prices increasing, and that's really due to tariffs. And that's compared to a longer run trend of very, very mild deflation in goods. So that's moving inflation up. On the other side of that, good news that housing services inflation has been coming down and is expected to continue to come down. So if you remember a couple of years ago, that's the one that we kept expecting it to do that. Now it's been doing that for some time, and we expect to continue that. That leaves the biggest category is services other than housing services. And that's kind of been moving sideways over the last few months, but a significant part of that is non-market services. And we don't take a lot of signal about the tightness of the economy from that. So if you add all that up, a couple things to say. One is that inflation away from tariffs is actually not so far from our 2% goal. We estimate, people have different estimates of what that is, but it might be, 5 or 6 tenths. And so that, if it's 2.8, then core PCE, not including tariffs, might be 2.3 or 2.4 in that range, something like that. So that's not so far from your goal. So that we look at that, and the thing about tariff inflation is the base case is that it will come, and it probably will increase further, but it is that it will be a one-time increase. And we've been very focused for all of this year at making sure that that's the case and thinking carefully about what are the pathways through which it could become something else, troublesome inflation. One of those would be, a really tight labor market. We don't see that. Another could be inflation expectations moving. We don't see that. So I think we're watching this very carefully. I think it's not the case that we're just assuming that it's going to be a one-time inflation. We understand fully that this is a risk we have to monitor and ultimately manage.
With the stubborn in services inflation, what are some of the things that the Fed could do to address that, and especially when we're seeing potentially labor supply challenges?
Sorry, say the first.
The stubborn services inflation that you mentioned.
Services inflation, yeah. Well, again, the part of services inflation that isn't coming down as we would like it to is the non-market part of non-housing services. And overall, that's just something that we expect will come down. The non-market part of it should come down. It largely reflects higher stock prices and financial services that are imputed rather than actually paid is a big part of that. But also just we think policy is still modestly restrictive in my telling. So that's the kind of thing that should lead to a gradually cooling economy. That's one of the reasons you see a gradual. That I want to say, though, we're absolutely committed to returning inflation to 2%. If you look at longer-term surveys or market pricing, you will see that's a credible commitment, and there should be no question that that's where we're going.
Chris.
Great, thank you. Chris Rugaber at Associated Press. So there's a big investment boom in AI infrastructure right now, as you know, and wondering if the existence of such a boom would indicate that rates are not that restrictive after all. And could further rate cuts at this point perhaps fuel an excess level of investment there or market bubbles? How is the Fed thinking about that?
So I don't think that you're right. There are a lot of data centers being built and other investments being made around the country and around the world. Big U.S. companies are just investing a lot of resources in thinking about how AI, which will be based on those data centers, run through those data centers, is going to affect their businesses. So it's a big deal. I don't think that the spending that happens to build data centers all over the country is especially interest sensitive. It's based on longer run assessments that this is an area where there's going to be a lot of investment and that's going to drive higher productivity and that sorts of things. I don't know how those investments will work out, but I don't think they're particularly interest sensitive compared to some of the other sectors.
And then just a quick follow-up. You mentioned that you do have data that you're looking at for inflation and growth in the absence of government data. Could you give us a sense? I think we know a lot about the jobs data that's out there. Can you give us a sense of what you're looking at to track inflation in the absence of government data? Thank you.
So it's a lot of things, and it doesn't replace government data. But you know all of these. I'll just mention some of the many names: Price Stats, Adobe, and others. For wage inflation, there's ADP data. On spending, you're going to ask about spending at some point. There are lots of other things that we look at, but it's many different sources, and again, including what we get out of the Beige Book, which will be sort of come out mid-cycle as always. And it doesn't replace the government data, but it gives us a picture. Again, I think if something material were happening, if there were material developments, I think we would pick that up. I don't think we'll be able to have the very granular understanding of the economy while this data is not available.
Howard.
Howard Schneider with Reuters. Thank you. I just wanted you to elaborate a little bit on what you said a moment ago about the continued shutdown, making it more difficult to make a move in December, and that may make you more cautious. To the degree you are relying on private data that isn't the gold standard, or that you're relying on your own surveys or the Beige Book, do you worry at some point you're going to have to start making policy by anecdote?
This is a temporary state of affairs, and we're going to do our jobs. We're going to collect every scrap of data we can find, evaluate it, and think carefully about it. And that's our jobs. That's what we're going to do. If you ask me, could it affect the December meeting? I'm not saying it's going to, but yeah, you could imagine that what do you do if you're driving in the fog? You slow down. So that could or could not. I don't know how that's going to play into things. We may get the data may come back, but there's a possibility that it would make sense to be more cautious about moving. I'm not committing to that. I'm just saying it's certainly a possibility that you would say we really can't see, so let's slow down.
As a follow-up in the debate on this meeting, we saw recently some pretty big layoff announcements coming from Amazon and others. Wondering if that figured into the discussion at all, that you're starting to see this tension between growth and employment starting to be resolved, to the detriment of employment. And secondly, some of the stress is starting to appear in the bottom spur of the K, as they call it, household health premiums that are going to possibly be going up quite substantially, things like that. Has that started to become a factor in your policy discussion?
So those are both things that we're watching very, very carefully. To start with the layoffs, you're right. You see a significant number of companies either announcing that they are not going to be doing much hiring or actually doing layoffs, and much of the time they're talking about AI and what it can do. So we're watching that very carefully, and yes, it could absolutely have implications for job creation. We don't really see it in the initial claims data yet, Now, it's not a surprise that we don't. It takes some time for it to get in there, but we're watching that really carefully. But again, don't see it yet in the initial claims data. On the K-shaped economy thing, I would say the same thing or similar thing. We are, if you listen to the earnings calls or the reports of, big public consumer-facing companies, many of them are saying that there's a bifurcated economy there, and that consumers at the lower end are struggling and buying less and shifting to lower-cost products, but that at the top, people are spending at the higher income and wealth, and so much anecdotal data on that, and so we think there's something there.
Edward.
Thank you. Edward Lawrence with Fox Business. So, Mr. Chairman, I want to take another crack at the further reduction of rates is not a foregone conclusion. So in December, he said, far from it. So if a cut might not be on the table for December because of lack of data, what does the other concerns then stem from? So if it's not lack of data as the reason December is not a foregone conclusion, what other things could be the concern then? Well,
the perspectives of people on the committee that, we've now moved 150 basis points, and that we're down into, you're into that range between 3 and 4 where many estimates of the neutral rate live in that 3 to 4% area. You're there now. You're above the median number for the committee, but I think there are people on the committee who have higher estimates of the neutral rate, and that's you can argue these positions since it can't be directly observed, the neutral rate. So, I think for some part of the committee, it's time to maybe take a step back and see whether there really are downside risks to the labor market, or see whether in fact the growth that the stronger growth that we're seeing is real. Ordinarily, the labor market is a better indicator of the momentum of the economy than the spending data. That's the lore. In this case, that gives a more downbeat read. So people just have, again, we've cut 50 more basis points in the last 2 meetings, and there was a sense like, from some, let's pause here, kind of thing, and a sense from others wanting to go ahead. But that's why I say differing views, strongly differing views.
So on that division, then, you're talking about going forward. So what's more important in this division? Is it inflation risks? Is it employment risk? Or is there a deeper philosophy division among the board?
Look, everybody on the committee is deeply committed to doing the right thing to achieve our goals, maximum employment and stable prices. You have differences on how to do that. And as I mentioned, some of that is different forecasts, but a lot of it is also different risk aversions to the different variables, which is common through all Federal Reserves. People just have different risk tolerances, let's say. So that leads you to people with disparate views. You will know that from the speeches you've been listening to from my colleagues. And so we're at a place now where we have, in fact, cut 2 more times. And we're 150 basis points closer to neutral, wherever that may be, than we were a year ago. And so there's a growing chorus now of feeling like maybe this is where we should at least wait a cycle, something like that. That's what it is. It's just what you think it would be. It's and again, you've seen it in the September Summer of Economic Projections. You've seen this in the public remarks of FOMC participants, and now I'm telling you that's what you can expect that in the minutes. And I'm just telling you that's what happened in the meeting.
Elizabeth.
Thank you so much. Elizabeth Schulze with ABC News. What is your explanation for why the job market is weakening right now, and what will this rate cut do to improve the job market?
So I think there are 2 things affecting the job market, and one of them is just a dramatic reduction in the supply of new workers. And that's 2 things. That's declining labor force participation, which is a cyclical thing. And then there's declining immigration, which is just a big policy change that actually began in the last administration and it has been accelerated now. So a big part of the whole story is that supply side story. Okay. In addition, labor demand has declined, and so the unemployment rate has gone down, meaning that demand for workers has gone down a little more than supply. So that's what's going on, but it is mostly a supply function. It's mostly a function of the change in supply, I think, and many people think. So the question then is, what does the our tool do, which supports demand, and and I would just say, when you're in a situation where job creation, if you adjust for likely overcounting in the way that BLS does its work, is pretty close to zero. So maximum employment doesn't, on a sustainable basis, if you're creating zero jobs, if it's in equilibrium, if it's in balance, it's a pretty, as I said before, a pretty curious balance. So, I thought, and many of my colleagues thought, in fact, you've seen the last two meetings, that it was appropriate for us to react by supporting demand with our rates. And we've done that. We've reduced so that rates are looser. I wouldn't say that they're accommodative right now, but they're meaningfully less tight than they were. And that should help so that at least the labor market doesn't get worse. So it's a complicated situation, and some people argue that this is supply and we really can't affect it much with our tools, but others argue, as I do, that there is an effect from demand and that we should use our tools to support the labor market when we see this happening.
You also talked about tariffs causing a one-time price increase. Should American household consumers expect that inflation will continue to go up this year because of those tariffs?
So the basic expectation is that there will be some additional increase in inflation because it takes a while for tariffs to work their way through the production chain and finally get to consumers. And we see this now from the tariffs that were put in place now many months ago. We see those effects, but if you put tariffs in effect, and they've been coming into effect consistently in February, March, April, May, and that's all happening. So that'll continue to happen for some time, probably into the spring. These are not big increases, though. These are a tenth or so on inflation. They may be big increases on a particular product that's been tariffed, but overall, these are fairly modest. I think some projections go, we're at 2.8% inflation. You might get 2 or 3 more tenths or 4 more tenths maybe. But then, as all of the tariffs are in, they stop generating inflation. You've had a one-time price increase. As long as you're not, at least this is the theory, this is how we believe and hope that it will work out. Once the last tariff is put on something, at that point, it becomes a higher price level, but it stops going up, if you will. Prices stop going up. They'll just be at that level. And then measured inflation will come back down to non-tariff inflation. As I mentioned, non-tariff inflation is not so far from 2% now. Now, consumers are not interested in that story. Their prices are higher. More than that, the reason they're so unhappy about inflation is the inflation that we had in 2021, 2, and 3. Because you can say that prices aren't going up as much, but that doesn't mean people aren't feeling those higher prices from the inflation we had 2 or 3 years ago. They are, and that's, I think, a large part of why the public, if you sample people, inflation is still very much making people quite unhappy. Even, and it's nice that, that prices are not going up as fast as they were, but they're still much higher than they were. And it'll take some time for that effect to wear off. As real incomes rise, it will feel better over time, but that's going to take time.
Michael McKee from Bloomberg Television and Radio. Do you have any concerns that equity markets are or are close to being overvalued at this point?
We don't look at any one asset price and say, hey, that's wrong. It's not our job to do that. We look at the overall financial system, and we ask whether it's stable and whether it could withstand shocks, right? So, banks are well capitalized, while some households are clearly under stress. In the aggregate, households are in good shape financially, relatively manageable levels of debt. At the lower income spectrum, you are seeing rising defaults, particularly around subprime auto, but nonetheless, in the aggregate, pretty good. and you don't see too much leverage in the banking system or the financial system. It's a mixed picture, but it's not an overly troubling picture. And again, I'm not. It's not appropriate. We don't set asset prices. Markets do that.
Well, you must be well aware that by lowering interest rates, you're contributing to additional asset price increases. And I wonder how you balance the idea that lowering rates would help the labor market with the reality that it seems more likely to be stimulating increased investment in AI, which is the rationale for thousands of job cuts that have been announced in the last few weeks.
Yeah, I don't think interest rates are an important part of the AI of the data center story. I think people think they're great economics in building these data centers, and they're making a lot of money building them, and they think they have very high present value and all that sort of thing. It's not really about about 25 basis points here or there. We use our tools to support the labor market and to create price stability. That's what we do. That's our two jobs, right? So we're here by lowering rates at the margin, that will support demand, and that will support more hiring, and that's why we do it. Now, no 25 basis point or even 50 basis point hike is going to be a dispositive thing, but ultimately, lower rates will support more demand, and that'll support hiring over time. And of course, we also have to be careful about this, which is what we've been doing, because we know where inflation is, and we know that, I've told you the story. It's a complicated story, but this is the best assessment that we can make. Because there's uncertainty around inflation and the path ahead for inflation, that's why the pace we're going has been a careful one.
Victoria. Hi, Victoria Guida from Politico. On AI, I'm just wondering, it seems like a lot of the economic growth that we've been seeing is fed by investments in AI. So how worried are you about what a sudden contraction in tech investment would mean for the overall economy? Is there enough strength in other sectors? And specifically, are there any lessons that you take from the 1990s in how you might approach what's happening right now?
Yeah, this is different. In the sense that the companies that are so highly valued actually have earnings and stuff like that. So if you go back to the 90s and the dot-com, these were ideas rather than companies, and so there's a clear bubble there. Whereas I won't go into particular names, but they actually have earnings, and it looks like they have business models and profits and that kind of thing. So it's really a different thing. The investment we're getting in equipment and all those things that go into creating data centers and feeding the AI, it's clearly one of the big sources of growth in the economy. Consumer spending also, though, has been, is much bigger than that, and has been growing and has defied a lot of negative forecasts, continuing to do so this year. Consumers are still spending. Now it may be mostly higher end consumers or maybe skewed that way, but the consumer is spending, and that's a big chunk of what's going on in the economy, substantially bigger than AI. You can point to growth. I mean, actually, growth as opposed to level, but consumer spending is a much bigger part of the economy.
And why do you think that the labor market is slowing so much, even though consumer spending is strong?
Why has it slowed so much? Well, what's happened is that the supply of workers has dropped very, very sharply due to mainly immigration, but also lower labor force participation. So, and that means there's less need for new jobs, because there isn't this flow into the pool of labor that, where people need jobs, because there aren't those people now. So there's not a supply of workers showing up for jobs. In addition, demand has also gone down, and so has labor force participation has declined, which is more of a sign, in this case, of demand as well as trend. So I think you're seeing some softening. The economy's growing at a slower rate than it was, 2.4% last year. We think around 1.6% this year. It could have been a couple of tenths higher if not for the shutdown. And of course that will reverse. But you still got the economy growing at a moderate pace.
Andrew.
Hey there, Andrew Ackerman with the with the Washington Post. I wanted to ask if you could elaborate on how you think about policy in the context of the data drought. Does it make you inclined to stick with your plans as set out in September in the absence of the data that might change your mind, or does it make you inclined to proceed with added caution because of uncertainty?
Yeah, well, we'll know when we face that question, if we face that question. It'll probably be argued both ways, right? But I've said a couple times here that, if you really aren't getting information you really don't know, and the economy looks like it's solid and stable and hasn't really changed, there will be an argument. I don't know how persuasive it will be, but there will be an argument that, you slow down when you can't see as far ahead. Others may argue, I'm not sure where this argument will come up, but you're perfectly right that you could also argue, well, things haven't really changed. But you might not know that, So I don't know whether we'll face this or not. I hope we don't. I hope by the time of the December meeting we're getting, a better flow of data. But if we're going to have to do our jobs one way or the other.
Okay. I also just wanted to ask a FinReg question. I think several years ago you said the overall amount of capital in the system was about right. As the Fed moves forward with a revised Basel proposal, potentially changes to the GSIB surcharge, has that changed at all? Or are you planning to significantly reduce the amount of capital in the system? Thanks.
So there are discussions going on, I think, among the agencies. And I don't want to get ahead of those discussions. I continue to think that the level of capital, when I said that in 2020, was about right. And of course, there's been much capital added since then through various mechanisms. But I look forward to. I know those discussions are really just getting going. They haven't come to the point where they're got a whole plan and that kind of thing. So I really don't have much to say on that.
Brian. Hi, Chairman Powell. Brian Chung with NBC News. Is the weakness in the jobs market accelerating, and who's at risk if the interest rate cuts are not the effective medicine for a further slowdown in the labor market?
So we do not see the weakness, as you put it, the weakness in the job market accelerating. I would say, and again, we didn't get the September employment report, payroll report, but we look at, the unemployment insurance claims, initial claims, are reported at the state level, and we still get those, and we can accumulate them and get the national number. And there's really, no story. You can look at the numbers. Same thing with the job openings we get from Indeed. There's just no story over the last 4 weeks. It's kind of stable. So you don't see anything that says that the job market is, or really any part of the economy is making a significant deterioration. Don't see that. You see more things like I mentioned, though, which is you see big companies making announcements of either of layoffs or of the idea that they won't need to hire. Their number of employees is not expected to go up over a number of years. There may be different people working there. They say that too, but they don't need a bigger head count. So you see those kinds of things. You don't see it in the aggregate numbers. The layoff numbers have not gone up, but job creation is very low. And the job finding rate for people who are unemployed is very low. But the unemployment rate is very low as well. 4.3% is a low unemployment rate.
So as you make these cuts, is it the lower income workers that you're thinking about, or those who might have their jobs automated? Is there a particular section of the labor market that you're particularly?
So we can't, our tools don't allow us to target any demographic or any income level and that kind of thing. I do think that people, we saw this during the global financial crisis and the long recovery. If you have a long period of very strong labor market conditions, it benefits people at the lower end the most. The last 2 or 3 years of that long expansion, people at the lower part of the income spectrum were getting the biggest benefits, and lots of things were happening in that space demographically, which were very constructive. And we're not at that place right now. But so, a stronger labor market is the best thing we can do for the public. It's also part of our job. It is half of our job, but it is absolutely the best thing we can do for people. Along with keeping prices stable, those two things. inflation also hurts people on fixed incomes more than other people.
Courtney.
Hi, Chair Powell. Courtney Brown from Axios. As you know, the 12 Reserve Bank presidents' terms are up for renewal at the end of February. I'm wondering if you can give us a timeline for when the board will consider those reappointments and whether we can expect everyone to be re-upped or if we can expect some changes.
So it's a process that we go through under the law. The way the law works is we have a reappointment process every 5 years for all of the reserve, each of them and all of them. We're in the middle of that process, and we're going to complete it in a timely way. And that's really all I can say.
Okay, thank you.
Daniel.
Daniel Davis, Agence France Presse. You've now had dissents in 3 consecutive FOMC meetings, but in this meeting you had dissents going in both directions, and you've just mentioned there's strong disagreement over the future path of rate cuts. Have these disagreements complicated your role presiding over the FOMC meetings, and if so, how?
I wouldn't say that, no. I think you have to take what comes, and what comes right now is a pretty challenging situation where we have, first of all, we have 4.3% unemployment. We have an economy that's growing close to 2%. So, overall, it's a good picture. It's a good picture. But in terms of our policy, we have upside risks to inflation, downside risks to employment, and this is a very difficult thing for a central bank because, one of those calls for rates to be lower, one calls for rates to be higher. We can't do both, so we have to balance the two. And so it's a challenging thing, and as we have worked our way through this process, you would expect that there would be a range of views across the committee on what to do and the speed with which we should do it. And that's what we have. That makes a lot of sense to me. All of these people are, people who take their jobs very seriously, work very hard at this, and just want to do what's right for the American people, but they have different views on what that is. And, it's an honor to work among people who care that much. It is, but I don't feel that it's unfair or anything like that. It's a time when we're making quite difficult judgments in real time, and I believe we'll get through this. And I think we've done sort of the right thing so far this year. I think it was appropriate for us to be careful about this. I think it would not be appropriate to just ignore or assume away the inflation issue. At the same time, I think the risk of higher, more persistent inflation has declined significantly since April. And if we do wind up resuming rate cuts at some point, we will at some point. I think we're trying to get to the end of this cycle with the labor market in a good place and with inflation, on its way to 2% or at 2%. So that's all we're trying to do, and we're doing it under, quite challenging circumstances and doing the best we can.
We'll go to Jennifer for the last question.
Thank you so much, Chair Powell. Jennifer Schonberger with Yahoo Finance. Both regional and large banks have taken losses on loans given delinquencies on subprime auto loans. JP Morgan CEO Jamie Dimon warned, when you see one cockroach, there may be more likely. I'm curious how the Fed is looking at these loan losses and if it poses risks to the financial system or the outlook for the economy. Is it a warning sign?
So, we're obviously we watch these things very carefully, credit conditions very carefully. You're right. You've seen rising defaults in subprime credit for some time now, and now you've seen a number of subprime credit, automobile credit institutions having significant losses, and some of those losses are now showing up on the books of banks. We're looking at it carefully. We're paying close attention. I don't see at this point a broader credit issue. It doesn't seem to be something that has very broad application across financial institutions. But we're going to be monitoring this quite carefully and making sure that is the case.
And then separately, many, you yourself have said that we're in a bifurcated economy right now with high net worth individuals continuing to spend with the lower income pulling back. How much of consumer spending continuing hinges on the stock market remaining strong? In some odd way, does the market help keep the economy buoyant?
So there's some relationship there, but remember, the more wealth someone has, the lower an additional dollar of wealth matters. So your marginal propensity to consume declines quite dramatically as you reach levels of stock market wealth. So, the stock market, it would affect spending if the stock market went down, but it wouldn't drop sharply unless there were quite a sharp drop in the in the stock market. People at the lower end of income and wealth have a much higher marginal propensity to consume of an incremental dollar of income or wealth, but they don't have the stock market wealth. So I think it's certainly a factor supporting consumption right now. But you would see it if you saw a material correction in spending, but it wouldn't be. You shouldn't think that it'll dollar for dollar stop consumption, because that wouldn't be the case. Thanks very much.
That was Federal Reserve Chair Jerome Powell wrapping up his news conference there. The central bank cutting rates for the second time this year by 1/4 percentage point as expected. But what markets were not expecting, 2 dissents. Fed Governor Stephen Myron wanted a bigger 50 basis point cut. Kansas City Fed President wanted no cut. The market taking a leg lower after Powell said in his statement that a rate cut in December is not a foregone conclusion. And despite the recent reports of corporate layoffs, Powell shook off concerns about the health of the labor market, saying it's cooling gradually. Just look at the popular averages here right now. Dow is down about 120 points. The S&P 500 broad gauge, it's basically flat here. The NASDAQ is in the green. It's up about 0.4%. Let's get to senior reporter Allie Canal with a closer look at the market action. Allie.
Yeah, that's exactly right, Josh. Stocks giving up earlier gains as investors really digested Powell's messaging there that December is still very much TBD. Powell did make it clear throughout the press conference that the Fed is watching very carefully how the labor market evolves, as we've seen companies from Amazon to UPS announce layoffs and hiring freezes. So far, those cuts haven't shown up in the data. Jobless claims remain steady, and that's something that Powell specifically talked about. But he did say it could take time for that to filter through. And the key variables heading into December are labor market softening, tariff-driven inflation, and the lack of fresh government data because of this ongoing shutdown. Now, Powell did say the Fed will stay data dependent. They will make decisions meeting by meeting, that they have other types of anecdotal and private sector data to go through. Markets, though, had been really betting on another December rate cut. So Powell's more cautious tone prompting a little bit of repricing there. You were just talking about the Dow of around 100 points. You can see when that happened just shortly after the press conference began. Same story there with the S&P 500. We're down around 0.1%. The NASDAQ holding in the green. We did see the NASDAQ dip into the red and then bouncing back. We are up roughly 0.4% as Nvidia continues to hover at that $5 trillion market cap. But I do want to take a look at the bond market, because we did see a bit of a reaction due to that cautious tone. 10-year yield is up 7 basis points, inching closer and closer to 4.1% as markets are recalibrating that messaging there from the Fed. 30-year yield, similar story, up 5 basis points, trading at just around 4.6%. And then if you look on a sector basis, usually when we see a rate cut, that benefits those more interest rate sensitive areas of the market. But you are seeing real estate, the biggest laggard of the day, down over 2.5%. Financials, another rate sensitive area of the market, down 1.8%. Consumer discretionary, down 1%. So again, there have been increasingly more and more optimism, I would say, when it comes to yet another rate cut in December. But Powell clearly throwing some cold water on that notion, and the fact that we did have those 2 dissents shows just how split this FOMC really is at the moment, Josh.
All right, Allie, thank you. Appreciate it. Well, for more on Powell's remarks, we're welcoming back now JP Morgan Asset Management's Mira Pandit, along with Colin Martin from Schwab Center for Financial Research. Welcome back to you both. Mira, I'll start with you. You were listening carefully to Jay Powell field all those reporter questions. What were your big takeaways?
If we think about these press conferences, they're often used as a forward guidance tool, and Chair Powell hit that right on the head right in the beginning, emphasizing that December rate cut is not a foregone conclusion. Now, what's interesting as we look at some of the market pricing is if you look out to next year, we've been saying, look, the market expects the interest rate environment to get back to neutral. Is the Fed quite there? But actually, you might be in a situation where both the market and the Fed think we're going to get to neutral, but they have very different conceptions of what neutral is. with the market anticipating that neutral is around 3%, but the Fed actually thinking maybe it's closer to 3.5%. And what's interesting is that Chair Powell has characterized the cuts as risk management, which he said before. And what that implies is maybe we're not that far from where we need to be. And inflation, if you strip out some of those tariff effects, PCE might actually be on a core basis closer to 2.2 or 2.3%. So you put all of that together, and while there's a lot of dissent and discussion within the Fed, it actually seems like they're a lot closer to the end game than maybe markets appreciated.
Colin, you were listening as well. Your big takeaways.
Yeah, I think a big thing about the Powell comment about a December cut not being a foregone conclusion, I think that actually even minimizes it. He then said it again and said it's far from a foregone conclusion. So that's kind of in line with our thinking. And he laid out his thoughts there about the cooling market, the cooling labor market, where it's just that. It's cooling. It's not falling off a cliff. We're seeing this gradual slowdown. And there was a key point he made as well when he talked about what we're seeing with the labor market, but then also what we're seeing with the growth outlook right now. And he questioned if the growth we're seeing is real. You know, we saw that those really positive revisions as we got the second and third revision to GDP that showed that the economy's growing, the consumer's spending. So I think his thinking, and this might just be Powell, maybe it's not indicative of the whole committee, but should we be focusing more on that than the slowdown in hiring and the unemployment rate at 4.3%. So I think that's what we're focusing on. As we talked about earlier, things are okay right now. We don't think the economy has an interest rate problem. And I'll build on Mira's points. What is the neutral rate? If the unemployment rate's at 4.3% right now and inflation's near 3%, we're probably not that far off from neutral. And neutral is probably not at that 3% or less level that the markets are pricing in.
Mira, did you hear anything today in the presser that caused you to change how you think about advising clients about where to put money to work, where the opportunities are, what to avoid?
I think that we have to consider the market fundamentals as opposed to some of the assessment of the Committee of the Economy. I think we're all looking at the same data and looking at things pretty similarly. There's no risk-free path here. There's a good case to stay where we are in terms of rates, good case to cut. But when we think about what's going on in the markets themselves, we certainly want to be mindful that there is this everything rally going on, but we don't need to rally behind everything. We need to make sure we're still geared towards quality. We need to make sure we're still managing concentration risk and some of the valuation risks within portfolios, and maybe AI-proofing our portfolios to some extent. We've seen the AI trade move from just concentrated innovators in AI to some of the AI enablers in industrials and utilities. And the next phase is the AI adopters. Let's see how strong that adoption does come through, and in particular that paid adoption. But let's also think about trades outside of the AI complex. Things like financials. We go back to earnings season and we see that financials are going to contribute about 44% of the overall growth in earnings of the S&P 500. So that's where you're getting your earnings growth outside of tech, unrelated to AI. Think about making sure you have some balance in your portfolio across different areas that could continue to have some legs.
It was interesting because the AI trade and trend came up, right? And he was asked about that. And it was interesting how Powell talked about it's different, he said, than the dot-com era. He emphasized that. He said how these companies have earnings. It does come, though, as there have been some high-profile investors who have thrown some caution flags. Some have even said they hear echoes of the dot-com.
Well, as it relates to monetary policy specifically, I think that Chair Powell is certainly right in the fact that these are not really interest rate sensitive deals, because a lot of that CapEx that's being spent is not because rates are low and companies are levering up. It's that they're spending the cash that they have. They are generating revenue to fuel future investment. And some of it is really coming from the idea that these stocks continue to go up. So you think about the equity component that's really funding a lot of this CapEx. So I do agree with Powell that the interest rate component of all of this is not as relevant to some of this AI spending and CapEx, which really brings us back to what we were talking about earlier and an hour ago in terms of the fact that a lot of the challenges, whether it's the potential bubble within the equity market or within the economy, if it's any weakness in the jobs market or the housing market, is not actually all that interest rate sensitive.
On the lack of government data, right, Colin, that came up as well. And Powell gave an answer saying, listen, basically we still have a picture of what is going on in the economy, in the labor market. How much of a challenge has it proven to you in your job? I ask only because, Colin, some investors have said, listen, I have plenty of lines of sight still. In the economy, I got I got bank earnings, I got credit card data. Where are you trying to fill in the gaps?
Yeah, we're using some of those alternative data metrics. We know that ADP is going to start releasing that weekly employment release. We have a lot of surveys, whether it's from the district banks themselves. I think Powell said they're kind of leaning on them. We get ISM surveys, consumer confidence. So we can fill in the gaps, but it's really difficult to truly fill in the gap without the CPI, without the jobs data. We're big fans of that government data. It's comprehensive, it's available to everyone. And a risk we see in the shutdown, but even if there's a lack of trust with government data going forward, if we get these private pockets of data, does it go to the highest bidder? Who has access to that? So for now, it's okay. As time goes on, it's going to get a lot more difficult because the payrolls number, the unemployment rate, those really matter. And without them, it's tough to get a complete picture of what's going on.
All right, well, you guys have both given us a great picture today. Colin, Mira, thank you both so much. Appreciate it. The Fed cutting interest rates by 25 basis points, but the path forward may be a bit uncertain. For more, we're bringing now Yahoo Finance Fed correspondent Jennifer Schonberger. Jen.
Hey there, Josh. Fed Chair Jay Powell clearly pulling back market expectations for a rate cut in December, saying that it was not a foregone conclusion. And he sort of slipped up towards the end of the press conference saying, if we cut again, and then sort of caught himself and walked that back again. Take a listen to what he had to say.
There were strongly differing views about how to proceed in December. A further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it. Policy is not on a preset course.
He characterized the rate cut today and last time both as a risk management move, but said that may not be the case going forward. He says the Fed has cut twice now and that we are now 150 basis points closer to neutral than we were a year ago. And so that perhaps, quote, there is a growing chorus of maybe we should wait a cycle. So more hesitation there. Interestingly, I noticed that Chair Powell was not all that worried about the state of the job market, given the layoff announcements that we've seen this week from major companies. He said that they've been looking at the state level unemployment claims, and those have remained stable. And so while we are seeing bits and pieces of layoffs here and there, he says it's not showing up in the aggregate data right now. He seems to be more concerned about the supply side than the labor side. He thinks it's really immigration that's weighing on the supply of workers and bringing down the strength of the labor market. So that was an interesting point there. And he also talked about equity valuations. He says that it's not an overly troubling picture, and he painted a different picture of now versus the 1990s. He said this is not the go-go 90s bubble because back then companies were just more about ideas. Today, companies are actually trading on real earnings growth and that they have actual business models. And he said that effective December 1st, they will freeze the size of the balance sheet. And the reason that they opted to do December 1st was to give markets a bit of time. However, as we go into next year, there is a chance that the Fed could begin buying some more treasuries, more on the shorter end of the curve, to keep the balance sheet stable and align more with what we're seeing as far as issuance from the Treasury. Josh?
Great summary. Thank you, Jen. Appreciate it. When we return, a preview of big tech earnings. Everything you need to know. Stick with us. Welcome back. We've been locked in on the Federal Reserve's October decision to cut interest rates by 1/4 point. Second straight meeting where the Fed reduced interest rates. Losses accelerating, at least for the Dow, the S&P 500. The NASDAQ here's holding on to gains. Worth noting as well, the 10-year yield back above 4%. But just looking quickly at the major averages, we've got the Dow down about 200 points. S&P 500 is down about 0.2%. The NASDAQ, as discussed, that is up about 0.3%. The Fed, not the only thing in focus today, far from it. Investors are eagerly awaiting now earnings from three magnificent seven names. And tech editor Dan Howley is here with me now to run through it all. Dan.
Yeah, this is my big part of the day.
Yes.
Obviously, Jerome Powell done speaking, so now I can take over, just like I always wanted. So yeah, we're waiting for Microsoft and Meta. They're going to land at 4:05 about. That's when we're expected both numbers to come down. Awesome on their part. Definitely doesn't make my job any harder. Let's talk about Microsoft first. First, for earnings per share, we're expecting $3.68 on revenue of $75.5 billion. That would be up from $3.30 and $65.6 billion last year. Now, the big number that I think everyone is going to be looking at is commercial cloud revenue. That basically is just kind of a catch-all for their cloud revenue generally. That's expected to come out at $48.6 billion. That would be a roughly $10 billion increase from the $38.9 billion we saw last year. And then intelligent cloud, that's the segment where you find Azure kind of encapsulated. That's expected to hit $30.2 billion. That would be up 25% year over year. Now, if that does hit, I think obviously investors are going to be pretty wild about that. Microsoft stopped reporting the AI contribution to Azure revenue, but Bloomberg's consensus estimates have it at 18.7%. That would be up from 12%. So seeing an increase in what AI is doing for Microsoft. And by the way, this comes the day after they came to terms with that deal with OpenAI, where Microsoft is going to get 27% of OpenAI Group Public Benefit Corporation. That's the
rolls right off the
arm.
tongue, doesn't
yeah,
it?
So easy. That's valued at about $135 billion. OpenAI's nonprofit gets $130 billion of that. So yeah, 27%. Big deal for Microsoft because, this has been kind of the overhang for OpenAI and Microsoft and their relationship. I think one of the things that really wasn't reported as much was the fact that Microsoft loses the first right of refusal advantage with OpenAI that they had previously had. Now, they were no longer the sole cloud provider. Oracle was clearly doing that with Stargate. So this is kind of just codifying that, OpenAI needs to grow faster than Microsoft is willing to or can. But on the flip side, OpenAI is committed to spend $250 billion on Azure going forward. So, look, man, Sam Altman's got to have some kind of money machine. If a company that doesn't make money is going to be paying those bills, but we'll see. That's future problems. That's not now problems.
So on this great debate, my friend, AI boom, AI bust, with these tech earnings that are about to hit, I mean, you're gonna put that debate to rest.
No.
But do you think you get more lines of sight into that debate with these reports?
I think so. I mean, every report kind of gives you a little bit more. I think, look, if we don't see positive momentum on Azure, and there has been positive momentum on Azure, we see it fall below expectations. You can probably expect NVIDIA to follow suit, perhaps, until we get some kind of explanation from Satya Nadella and crew. If I was talking earlier with one of our colleagues, if the CapEx declines, if they say that they're pulling back on CapEx, you can see a bigger problem for NVIDIA, AMD, anybody in that space, really. But this is one of the companies that is benefiting from the boom as far as selling it. I think, there was that MIT study saying, companies that use AI aren't necessarily seeing the benefit. There was, pushback back and forth.
Which sort of, I remember that headline hit, Dan, only because it seemed to play into like worst case scenarios, worst fears.
Yeah. I think, I've seen a number of use cases where, when it comes to Microsoft's productivity tools, AI makes a lot of sense. I mean, if you put me in front of an Excel spreadsheet, I know I write for a financial website. I don't know what I'm doing, but you could just use Copilot to navigate it. And you can probably do this, more or less do the same thing with Google Gemini. But so these tools do have a real world benefit in that sense. I think that it's just, people are expecting this huge explosion immediately. The adoption is going to take time. I was speaking with some folks over at Microsoft who said that now they're starting to see their clients really pick up and understand where the growth is going. And they admitted, look, at first, I think exactly what I said. Everybody thought it was going to be this big, AI's landing, now everyone's going to start spending. That's not necessarily the case. They're seeing individual groups in businesses pick it up, and then some other groups say, hey, we need that. So I remember years ago, one of my older jobs when Slack came out, they were like, we got to get Slack. And I was like, what is this Slack thing? And then, now obviously.
That's Stuart Butterfield.
Yeah. But I think it's going to be one of those.
All right, Dan, you're going to be very busy, my friend.
Yeah,
I
just want to go to sleep so bad.
I hear you. Who doesn't? All right, Dan, thank you. Now time for some of today's trending tickers, starting with Caterpillar. Company reporting an earnings beat for the third quarter. Caterpillar also delivering a better than expected fourth quarter outlook that outshone the increased impact from tariffs. The mining construction machinery maker noting that its outlook improved since last quarter, in part due to a record backlog and strong order rates. Turning to Fiserv, that stock sinking here as the company slashed its annual earnings guidance. Changes to its outlook came down to a series of factors, including the impact of deferred investments and the recalibration of optimistic growth assumptions in the original guidance. The payments processor also making a broad reshuffling across its senior ranks. Along with that executive shakeup was also a new strategic action plan called One Fiserv. And lastly, Amazon says that it has completed a massive data center project. The news coming as AI chip competition heats up among big tech firms. Anthropic's models will scale to use more than 1 million of Amazon's Trainium 2 chips. Anthropic will use these chips for training and inference from Project Rainier and other Amazon data centers this year. Well, coming up, we're checking in on where trade talks stand between China and the U.S. Stick with us. President Trump is scheduled to meet with Chinese leader Xi Jinping in Busan, South Korea overnight, and investors are paying very close attention. Our own Washington correspondent Ben Werschel joining us now. Ben.
Yeah, Josh. So we're only a few hours away from this meeting. As you mentioned, in South Korea, this will be the first time that President Trump and Xi Jinping have seen each other in person in about 6 years. So it's been a long time since they saw each other face to face, and there's a lot of anticipation here. This is the apex of an Asia trip for Trump that so far has seen him come from stop to stop, Malaysia, Japan, South Korea, and seen other leaders offer a lot of at least promises to the U.S. and to President Trump. That appears set to change with China. It's going to be kind of tougher sledding and tougher negotiations there on all sides. Although we have seen some movement already. Just in the last few hours, Agricultural Secretary Brooke Rollins confirmed a Bloomberg report that China did make its first purchases of soybeans in a while. She described it as multiple boatfuls of soybeans. This would be the first time in months that China has purchased any soybeans, and this is obviously a top agenda item for Trump to have China resume its purchases of U.S. soybeans. So that's significant. But the bottom line here is that I think the expectation, or what's baked in markets from trade observers heading into this meeting, is not less of a deal, but a diffusal of tensions, a kind of delay of escalation. No triple-digit tariffs, a delay on China's promise on rare earth export controls, these soybean purchases, things like that, to kind of push everything into next year and kind of keep things largely the status quo. The way there's an upside here, and this is notably what Trump is promising, is an actual de-escalation. He's talked about even lowering some tariffs that he's imposed around fentanyl. The question that remains is kind of what China is going to be asking for a return when they get there. They've been a little bit more mum about that. And when they sit down, how much space is there for negotiations, or are they just going to kind of push everything largely into next year?
All right, thank you, Ben. Appreciate it. Really? Alphabet, Microsoft, and Meta are about to release their earnings reports. We're going to bring you the numbers as soon as they break. Stick with us.